What if I told you that right now, a handful of stocks are perfectly positioned to soar as this new trade era unfolds? But first, let's unravel the secret forces driving this market mayhem. For months, tariffs have been the shadow hanging over the global economy. Companies froze investments, supply chains buckled, investors panicked. But yesterday, everything changed. President Trump paused reciprocal tariffs for every country except China, and then a bombshell. The US and China agree to a 90-day tariff truce. US tariffs on Chinese imports plummet from 145% to 30%. China slashes tariffs on US goods from 125% to just 10%. Even more shocking, China lifts its export ban on rare earth metals, the lifeblood of everything from electric vehicles to iPhones. Picture this. In a Shanghai boardroom, executives erupt in applause as the news breaks. On the New York Stock Exchange floor, traders scramble to buy, screens glowing green. The world's two economic giants have hit pause on their trade war, and the aftershocks are just beginning. Why does this matter? Because markets crave one thing above all: predictability. When companies know what to expect, they invest, they hire, they innovate. And that confidence, it sends stock prices soaring. But don't be fooled, this is just the opening act. But is it really that simple? Or, is a storm brewing beneath the surface? Let's get real for a moment. Tariffs aren't gone, they're just lower. The base rate on United States imports, still 10%. And Chinese goods? Well, a punishing 30%? That's triple what they were just a few months ago. Imagine, for a second, a CEO in Detroit staring at a spreadsheet. Shipping costs are up, profits are squeezed. And the real pain? It's coming in the second and third quarter, when those higher costs hit earnings reports. For consumers, that means possible price hikes just as summer spending heats up. Short term? Well, you should expect turbulence. But as new trade deals take shape, the path to new market highs is opening. So, how do you survive the storm? Diversification, forget putting all your eggs in one basket. Private equity? Yeah, high barriers. Crypto, wild swings. But real estate, especially diversified funds, offers stability and growth without the sky-high entry fees. But here's the real secret. The market isn't just numbers, it's psychology, it's fear and greed. Right now, the fear and greed index is flashing extreme greed. But just weeks ago, it was extreme fear, and that's when the smart money pounced. How do you know when to act? I keep an eye on the S&P 500's momentum, And I also track the VIX, which is often called the market's fear gauge. Whenever volatility really spikes and then, fades, as momentum starts turning up, that's basically the green light. April, the market just bottoms out. There's panic everywhere, honestly. But if you look at the data, it actually signals a reversal. Since then, the S&P 500 is up 15%, and the Nasdaq, it's up over 20%. The real lesson here is when others are fearful, that's when you want to be greedy. So, who are the winners in this new era? Broadcom, or AVGO, is now the sixth largest company in the S&P 500. Its chips, manage to dodge the new tariffs, and its software is really untouchable. Powering artificial intelligence for Google, Meta, and Apple, Broadcom is riding a market that's actually projected to grow about 28% a year for the next decade. Amazon, with the ticker AMZN, is seeing tariffs hit its e-commerce side. But honestly, Amazon Web Services is the real profit engine here, and it's the world's biggest cloud provider. Plus, Amazon's digital ad business is absolutely booming. And get this, the stock is trading at a 2-year low price-to-earnings ratio, making it about 32% undervalued. Google, or Alphabet with the ticker Google, still owns 90% of search, is charging into artificial intelligence, and is trading at decade-low valuations. Analysts are seeing a 54% upside here. TSMC makes about 90% of the world's advanced chips for companies like Apple, Nvidia, and Broadcom. It's up 30% this month, but, there's still a 41% upside. But here's the twist. The real opportunity isn't just in picking winners. It's actually in understanding the emotional currents that move markets. Every headline, every tweet, every policy shift. It's all part of a psychological game. The investors who thrive aren't just analysts. They're storytellers, reading the market's mood and acting when others hesitate. So, what will you do? Will you chase the crowd, buying high and selling low? Or will you use data, discipline, and a killer script of your own to seize the moment when the world is distracted? Here's what you need to remember. The United States and China's tariff truce has unleashed a market rally for the ages. Short-term volatility is inevitable, but the long-term outlook is bright as trade clarity returns. Diversification and a data-driven approach to sentiment are your shield and sword. And honestly, the biggest winners? Tech and semiconductor giants poised to dominate the next decade. If you found this analysis helpful, go ahead and smash that like button, subscribe for more Wall Street wisdom, and, share your thoughts below. Because in the end, the best investment isn't just in stocks, it's in yourself. This is more than a market story, it's your story. The next move is yours. Thanks for watching. Stay bold, stay smart. And remember, in the game of markets, fortune favors the prepared.